Let me start here by saying that I'm a bag holder. I've been wrong on Medical Properties Trust, ticker symbol MPW, for quite a while. I've lost money on it, and I wish that I had taken the short sellers more seriously, because in hindsight they were 100% correct and they deserve praise for the successful call. So keep that in mind as you listen to this video. I've been wrong before and I could be wrong again. Even then, I still hold a small position as part of my portfolio, and I haven't sold it because I still think that the risk reward remains relatively attractive for more aggressive investors, especially following the crash of the company's share price. However, I've stopped buying more shares of it as a result of my declining conviction of the company, and the second quarter results surely didn't help with that. The market initially reacted positively to these results, sending the share price about 5% higher, but I was troubled by two things that I view as very bad news for the company. Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and before I go into today's update on Medical Properties Trust, I wanted to ask you for a quick favor. Could you please check out my new Substack, which I just created? There's a bunch of free research there on REIT investing. It highlights some of my top picks for the second half of the year, and you can sign up to it completely for free. I'll leave a link to it in the description of this video. So the first piece of bad news relates here to the company's Steward Hospitals in Massachusetts. To give you some background here, about 2 years ago, Medical Properties Trust sold a 50% JV, the portfolio of Steward Hospitals in Massachusetts, to an institutional investor called McCrary. This deal was then often used as an example to demonstrate that its hospitals are highly valuable, and even very sophisticated investors like McCrary see value in them. Moreover, this JV deal was then also used as a case study to pitch other institutional investors to close more similar JVs to raise capital and pay off debt. While Medical Properties Trust just announced that this JV is going to zero, they are going to return the keys to the lenders, and it's going to be a total loss for Medical Properties Trust as well as its institutional partner, McCrary. Here's what Medical Properties Trust said about this deal. Due to unanticipated restrictions imposed by regulators that impacted the process of transitioning ownership of 8 hospitals operated by Steward in Massachusetts, Medical Properties Trust, which owns a 50% interest in these properties through a partnership that has a separate master lease agreement with Steward, expect to relinquish its ownerships of those properties to the non-recourse secured lender. As a result, Medical Properties Trust has fully impaired its equity investment in the partnership. The net FFO contribution of the joint venture in the second quarter was approximately $7 million or 1 cent per diluted share. So the management here is trying to reassure people that the financial impact shouldn't be significant in the near term, and they are correct, and this is in large part because they had managed to sell this 50% equity interest to McCrary, and they had then also added a lot of debt in this partnership. However, what I fear is that this massive failure will still impact Medical Properties Trust over the long run, because it's just a very bad look, and I fear that it's going to make it harder for Medical Properties Trust now to close more similar JVs with other institutional investors. These were supposed to be some of the better assets of Medical Properties Trust, and McCrary invested a lot of money in them and they lost all of it. And so I think that this is going to make other institutional investors quite reluctant to closing similar JV deals with Medical Properties Trust going forward. And yet the issue is that it really has to do more of these deals, or it has to sell more properties if it cannot do JV deals, because it has to raise a lot of capital to pay off its coming debt maturities, which are quite significant. The REIT also tried to explain on the conference call that this should be a one-off case, and they blamed it on the regulator. But, I've learned over the years to be quite skeptical of anything that the management says, because they've misled us quite a few times, being overly optimistic and then in the end negatively surprising us down the line. Therefore, this is bad news because of 2 key reasons. It will complicate raising more capital going forward, and it raises even more doubt about the re-tenanting process of the Steward hospitals. The second piece of bad news is that the company is again cutting its dividend, and even worse, this could come also with a share issuance down the line. The REIT has entered a new deal with its lenders to relax some of its covenants on the debt in exchange of Medical Properties Trust retaining a greater share of its cash flow and distributing less dividends to its shareholders. This is bad news because obviously the very fact that they even have to do this is very concerning, because it's a strong reminder that Medical Properties Trust really could go to zero still for shareholders. If they fail to handle their debt, they are not able to refinance or pay off the debt maturities in the coming years, this could go to zero, and they have billions of debt maturities coming their way. The interest rates also on those debt maturities are going to go up very significantly, and so it's going to have to sell a lot more assets in the near term. And it's a big question mark whether they will be able to do so. Moreover, further bad news is that because of REIT regulations, REITs have to pay out a certain portion of their cash flow in dividend to shareholders. Now, Medical Properties Trust may have to pay a portion of its dividend in the form of stock. And so this would lead to more share issuances, which obviously at these levels could be quite dilutive for shareholders. Okay, so that's all the bad news, and it sounds very negative, I agree, but there is a bright side to it. And the good news here is that Medical Properties Trust has surprised all of us, including me, in their ability to sell assets, and they've managed to raise quite a lot of capital. Here's what they said on their conference call. On our last quarterly update call, we expressed our belief that we would exceed our 2 billion full-year monetization target, and as Ed just pointed out, we have now executed more than 2.5 billion in year-to-date transaction. Very importantly, virtually all of these, a total of roughly 50 hospital facilities in 5 major transactions, have been executed at very attractive valuations, whether that's based on capitalization rates, IRRs to us, real estate replacement costs, our initial investment, and almost any other valuation metrics, particularly in light of the diminished values that other real estate categories have suffered during the same period. And this is very good news. Again, they had initially guided to sell 2 billion worth of assets in 2024. And many investors saw this as a very big challenge, and we suspected that perhaps they will come short of that. Well, we are now in August and they've already sold 2.5 billion. So this is very good news, and you have to give them credit for it. This will allow them to pay off all the remaining debt maturities of 2024, as well as a big chunk or even nearly all of their debt maturities in 2025. But before you get too excited, now the concerns switch to 2026, 2027, when the company has another 3 billion of debt maturities coming its way. So, it's been able to push the debt maturities and its issues further into the future, but it's not out of the water yet. And now the question becomes whether they will be able to sell more assets, because for one, they just had this massive failure in Massachusetts, which will obviously, lower the appetite from institutional investors to work with Medical Properties Trust. I would expect so, at least. And then the second thing to keep in mind is that yes, they've sold now 2.5 billion worth of assets, but these were likely their best assets, because when you're in a situation like Medical Properties Trust, you will first try to sell the better assets which still have a lot of demand from investors, that can be sold with relatively attractive cap rates, especially in such a tough environment as today with high interest rates and little transaction activity. But if that's the case and they've now sold their best assets, this means that going forward, closing more transactions will be more challenging, and especially so at cap rates that make sense to Medical Properties Trust. And so what this means is that if they now face more similar setbacks as they had in Massachusetts, they fail to sell enough assets to pay off their debt maturities, Medical Properties Trust could still go to zero. On the flip side, if the case in Massachusetts was truly a one-off, as the management make it seem to be, and they continue to make similar strong progress in monetizing assets, and then interest rates come down significantly as we are expecting, then the company could very strongly recover, especially if it has also managed to re-tenant its other Steward facilities with rents that are more or less in line with today or not too big of a discount, and they sell some of those assets back to operators, keep diversifying their portfolio. In that scenario, the company could realistically, in my opinion, double or even in a best case scenario triple from here. And this is the reason why I've held on to my position. I think that the risk reward remains decent for aggressive investors. But once more, I've been wrong again, and most likely I'm wrong again. This is one of the most speculative investments in my portfolio, and I can take this risk because the rest of my portfolio is much more conservative. It mostly holds more defensive rates like First Industrial, Essential Properties Realty Trust, BSR REIT, and so on. And if you want to access my entire real money portfolio, you can join High Yield Landlord, which is my REIT newsletter. For a 2-week free trial, it will give you immediate access to my entire portfolio, all my transactions in real time, a course to REIT investing, and much more. Again, completely free for the first 14 days. I'll put a link to it in the description of this video. Then if you thought that this update was valuable, please click the like button, subscribe to the channel. That will help me a lot to keep on growing. And finally, let me know in the comment section below what other REITs I should discuss next. I read all of your comments. Thank you so much in advance. See you at my next one. Bye bye.